Hey there, traders. It's Tuesday, January 11th, 2022, and we have a cherry bomb from Tasty Trade today. It's Strangle. Those videos usually do very poorly for me, but that's okay. Not doing it for the views. Hope you enjoy. For those of you that do watch, we're looking at Walmart. Has 4 drops of liquidity, an IV rank of 33, which to me doesn't scream short premium. And this trade, of course, is undefined risk on both sides of the trade. We are short put and a short call. I will give you an alternative that could help you sleep at night if you don't like unlimited risk to the upside. So stay tuned and let's get cracking, shall we? Hi everybody, my name is Neil and this is Option Theory. Thank you so much for joining us. You can see we're inside of simulated trading and inside of Thinkorswim. And if you watched yesterday's earnings trade in Roku, you'll notice that it's not in my activity and position statement here. However, just as proof of keeping it real here, I will show you. I actually did put the trade on in a real life here in a Roku. There it is. Hopefully, because the market is looking like up for NASDAQ, that will bring Roku up a little bit higher. So that is how we keep it real there, and we will come back there in just a moment to take a look at the alternative trade to today. So let's get today's trade going. Clicking on Analyze, going to Add Simulated Trade, we've got Walmart typed in up here. Which, by the way, let's take a quick look at that whoa, holy cow chart, right? So we're going to be taking a neutral position. I guess you could say we're in the middle of a range that it's been in. And we're looking at being at around 150 here and 138 here. So I guess kind of in between these bands. Can we stay there? This is a slower moving trade, right? Because we really don't want any movement and we just want time to go by. So let's see if this is a trade that we can be profitable on. Let's go down and open up the weeklies. We're going to be in the February 11th weeklies. Once again, if you watched yesterday's video, I gave my opinion about weeklies. But let's do it as sent to us here. We're going to be short the 138 put. And we're going to be short the 150 call. I'm going to hold down the control key and click on that. And that gives us, as I scroll here, pardon me to I clear my throat. There we go. I hope you could hear me the whole time. We'll see if that worked. Man. All right. Anyway, we're looking at the 150, 138 strangle here. Our credit of $214 is our max possible profit. Let's go to the risk profile. Let's set the date in the top right corner to match the date that we see here in the bottom left, which is 2/12. We're going to put that in there. We're going to stretch out our expected move, and we're going to set our price slices to break even at expiration. So our goalposts, there they are. They're within the expected move. So that's a lower probability of profit at expiration than I'd hoped for. And that's a 57% probability of profit at expiration, with unlimited risk to the upside and air quotes unlimited risk to the downside, but really it's not unlimited, right? And so the buying power effect in a margin account is going to be $2,600 roughly. If we were to change this to to our IRA account, let's go ahead and do that. I'm going to show you that. First off, to show you that, I really want to just show you my whole screen. There it is. I'm going to right click this and choose confirm and send. And you'll see we have an infinite maximum loss. It's going to buying power effect $2,300. But if I change that to an IRA, it's going to tell you that it's illegal because you can't do a strangle. You can't do the strangle, but it would be big bucks, right? Buying power reduction would be huge on this one. So let's set this back to margin. And we're going to set this and send this. Going ahead and hit send. Awesome. Now, let's switch back over to Tastyworks here after I turn this back on. Tastyworks here is where I have built out an alternative. And here is the alternative. Of course, it's a jade lizard, where we have the 138 put has stayed the same, but instead of a short 150 call, we're going to make it a long 150 call. We're going to sell the 149. So it's a $1 wide short call vertical at the top. We collect enough credit so that we have zero upside risk. And we have, of course, downside risk at the short put. You add 2 zeros to the end of this, and that's what you are looking at as a maximum loss, of course, minus the credit that you receive. And that credit we would receive would make our max loss $13,675 if we were to get filled at 125, with a probability of profit of not 57%, but 84%. And a P50, the percentage of chance that we're going to be able to collect half of the credit and get out somewhere in the next 31 days, is 86%. So higher probability. I wonder which you prefer. Do you prefer the strangle? For ease of management, should the trade move against you? In this case, if it moves against us to the upside, we don't have to worry. If it moves against us on the downside, we do have a short put. That's not awful. So Jade Lizard kind of combines the best of both worlds. Just my 2 cents. Anyway, thank you so much for making it this far into the video. Big thumbs up to you. And if you feel that I've earned a big thumbs up, there is one down there. It's not that big, actually. If you hit it, though, that it does feel big in my heart. All right, everybody. Until I see you in hopefully tomorrow's Cherry Bomb, may the market be with you.